Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, good to be back, especially after a day like yesterday. Markets are all down a little over 2%. Yeah, in a single day. That is not uncommon, by the way. It was uncommon for about 18 months there and kind of tricked everybody. They were hoping, that it would kind of stay that way, and I understand. But I'm here to tell you that is this is actually a good thing. This is really a good thing. You don't want stocks to go straight up. I know everybody else, oh yeah, that would be perfect. Well, when that happens, stock prices pull away from their underlying values. In other words, they're overpriced. Then the correction becomes really big, and that's not good. So, in fact, the stocks that have done the best over the past 5 years or so are the ones that are the most overvalued. And it reminds me that this is kind of like wash, rinse, and repeat. It's happening again, where you get a handful of sectors that are very big, technology primarily, and the stocks go up, so people keep buying them, and guess what? They're going to keep going up. As long as you keep buying them, they're going to go up. That's just the way it works. And then at some point in time, something happens and they start to go down, and then the same process works in reverse. It's one of the reasons you want to spread your stocks out. By the way, spreading them out means that you're going to have some money in some categories that are not keeping up with those that are going up really fast. So you can't have all the winners, and that's a problem for an awful lot of people because they just don't know. Nobody's ever shown them what happens, and a lot of people, quite frankly, especially people under the age of 50. I mean, it's almost like they just have to get their heads beat in for so long before they finally give it up and say, okay, now what were you saying? And, it's upsetting. Experience is a tough teacher. It's a really tough teacher. I like experience as a teacher, but I like it when it's someone else's experience that I'm learning from. And so that's what this show is all about. Feel free to give us calls, questions, comments. We're doing a seminar coming up here fairly shortly, May 8th. It's at Tri-Cities Corporate College. You can go to my website, bullingtoncapital.com, to sign up for it. It's free. And we're going to be talking about basic portfolio management skills. Why would anybody need to know this? Well, it's not like you're going to, it's not like it's going to affect you physically the way not going to a doctor would. It could, though, because stress levels get really high. And if you're reducing the stress level by understanding investments and how they work and how the markets actually work, how they really work, then you can relax. And that's one of the reasons that you want to learn how to learn the basic portfolio management skills. Not necessarily that you're going to use it, but if you understand it, then it doesn't upset you when you get these corrections like this. It doesn't upset you when a portion of your portfolio is underperforming the best performing category because you know that that's the way that it works. And there are all kinds of benefits to learning the basic skills. The basics are not very difficult if you have somebody who's been working with it for a long time and can explain it in English. And that's my goal. Try to get as much financial understanding out there as humanly possible. And I'm giving it all the effort I have because there are other benefits. This could help you avoid running out of money during retirement. That's a big benefit, I would think. It'll really help you when you're looking at a financial advisor. So if you know how to do the portfolio management portion of it, even though you're not going to, but knowing how to do it means you're going to select an advisor much more effectively. How's that? That's a big benefit. the peace of mind that you get from this. One of the reasons I'm not upset, market was down 2% yesterday. My stocks were all down 2% or more. Why am I not upset? Because I know that that's the way that works. And in the long run, what we're doing is the best thing. We're doing the best thing for the long run. Over the next year or two, your guess is as good as mine. I'm telling you, your guess is as good as mine. Now, if there's an area of the market, large cap growth, okay, that area is overpriced. But it's just one area. It does happen to make up a huge chunk of the stock market. So that's why everybody thinks that all stocks are going down. Well, not really. Some are going down a little bit less than others. Some of them have gone up a lot more than others, and that's the group. That's the category. And if you're putting a portfolio together today, you'd probably want to not have I think I have about a 10 or 12% allocation to that particular sector right now, that particular portion of the market in the models that I'm running. It's about 10 or 12%. It was down a little bit more than the rest of them. And I can tell you that on a day like yesterday, the dividend-paying funds tend to hold up a little bit better. The value-oriented tend to hold up a little bit better. But more importantly, coming out on the other side, the dividend-paying stocks have a tendency to rebound much quicker, or at least they have had a tendency in the past to rebound and recover quicker. So that's one of the benefits of dividend-paying stocks. A lot of them tend to rebound much quicker. And these are all the types of things that we'll talk about. You don't actually have to go to the seminar to meet with us. If you want to find out more about this, you can just call us. Go to my website. Phone number's all over the website at bullingtoncapital.com. You don't have a computer, it's 330-664-0700. 330-664-0700. The seminar is going to be May 8th, 8:30. I gave away my mind is going to me, a Chromebook. I gave away a Chromebook. We did a little drawing. Actually, I had to do the drawing after the seminar. Guy that got it, I went down, ordered it from Best Buy, picked it up, shipped it out, and it didn't turn on. It was broken. Best Buy gave me a broken, so I had to get another one. And I really like the other one. It's really nice. I'll do that again at the next workshop. They're not that expensive. They are nice. In fact, they cost about the same as a inexpensive laptop now, which is kind of interesting because that's really what they are. But a Chromebook basically has a Chrome operating system on it done by Google. So you can get online. You can do everything you can do on a regular laptop on it. It just doesn't have a whole lot of storage because they want you to use their services, which are pretty good, actually. Google Drive, you can keep everything right on online in the cloud, so to speak. So anyway, one of the reasons I do this is that we have several services through Bullington Capital where we have an account aggregator for our clients. They can sign up I love it. I track all my spending with it. I don't have to go to, I think I have, only three. There are three places that I used, 2 credit cards and a checking account that I really need to track. Those are the personal things. The business has a ton of stuff, but personally I only have 3 accounts that I really need to track. But instead of going to all 3 websites, I go to one. And it imports everything from all those, and I can export that to a spreadsheet, and then I can manipulate it any way I want. And it is just so much faster. And it helps you track large expenses. Like I have an alert set up that if something goes through by a certain dollar amount, let me know. It sends me a text to my phone. It sends me an email, and I can check it out. And most of the time, I already know what it is because I'm the one that's spending that money. But occasionally, I'll forget. And I haven't had anybody, try to take any money out of my accounts unlawfully. So that's good. And it does a whole lot more stuff. So we're going to give another Chromebook away at that workshop. And the Chromebook that I got to replace the one that was broken was from HP, and it was, man, that thing is awesome. I wanted to keep it so badly, but we'll do that again at the upcoming workshop. We'll give away a Chromebook because most of this stuff today is almost everything that we do now is cloud based. We have super high level security, by the way. In fact, Gerry, that does the trading and compliance in our office, also has to do the computers. Because we're a small firm, we wear a lot of hats. And I'll tell you, it's invaluable to have a guy like him on staff because you have a problem with any of this stuff, he'll figure it out. Like, look at he's split. He's Microsoft certified, and he'll get back to you. And I don't know how he does it actually, but I'm glad he's there. And Melissa, she handles all the administrative stuff, does all the RMDs every year, the calculations, all that. And I'll tell you, I have a superstar staff. There's only 3 of us, and then we've got 2 part-timers. But I'm telling you, those guys are so productive. It's mind-boggling. Without them, I couldn't do what I'm doing. There's no way. And anyway, they will help you with that kind of stuff. If you're a client, you have an account with Bullington Capital, you get help with all this stuff. All you have to do is reach out, send us an email. And incidentally, since I got on that subject, I've been meaning to get a hold of several people who have expressed interest in the semiconductors. I haven't been in a hurry because I don't know if you've been watching what's going on in the market. It's in correction mode. It's absolutely in correction mode. So, and I will be reaching out this week. I think there are about 10 of you that I still haven't gotten back to yet. And you're getting a better price than I did. So I think as usual, I bought within a couple percentage of the top. And I'm not upset by that at all. I'll end up adding to it. And semiconductors are there's some ETFs that again, I've got to get back to this week, and I think this is a really good time to start putting money into it. There are lots of things happening in that particular space. I think it's not going to be over anytime real soon. In fact, this is what's going on in the technology space is pretty significant. You're not hearing a lot about it yet. It's in the infancy stages. And I've been talking about it for a few weeks here, and it's a technology called 5G. You will be hearing much, much more about it over the years to come. And I'm talking over the next 2, 3, 4 years. You're going to hear a lot about this because it enables you to do so much. I mean, basically, your cell phone, your internet, and your cable television, they're all merging into one platform. And looks like at this point it's 5G. Now that could change. I mean, obviously it could change. But right now, that's kind of the direction. Also, the driverless cars and the Internet of Things, like your refrigerators. My car is freaky, man. It sends me texts saying, hey, you need to get your oil changed. I'm like, what? I don't think I signed up for that. How did you find me? Just kidding. Actually, the dealer set it up when I got the car. But it's wild. I mean, it's just crazy. And all that stuff's available because you've got technology's constantly changing. And I think one of the few constants in the world is change. But anyway, so yesterday, market was down 2%. And it just reminds me that, since the year 2000, we've had more days where the market's been up or down 2% in a single day than we did in the prior 50 years combined. Think about that for a second. So it's a little different. And computers are definitely a big part of that. So many programs now are funds are out there, and I get this magazine that I really don't like, by the way. It's called Modern Trader. I probably shouldn't give the name of it out. But it's okay. It's just that you can spend an awful lot of time doing things that are just not all that productive if you're reading all the articles. And I guess you could say that for just about any news source, actually, now that I think about it. But anyway, that kind of stuff can really take up an awful lot of your time. You're trying to figure out how to do computer algorithms. I've spent a lot of time in my career doing that. And one of the reasons that I've stopped more recently is that I'm not the only one that's been doing that. In fact, there are so many of them now. There are literally several thousand funds that are run by a computer program. That and some of them are so close to what I was doing. I started doing mine before those existed. Most of those are relatively new. And now they're so close that I really don't have to do that anymore. I don't have to do that. In fact, the semiconductor space, I have exchange-traded funds that are all different. Each one of them is run slightly differently. And that way I get better coverage of that industry than just going out and buying the semiconductor index. That's only 32 stocks, by the way. Semiconductor index, Philadelphia, is only 32 stocks. That is incomplete. So if you want to get the complete benefit, a little more diversification, a little safer that way, by the way, hit me up. Give me a call. Send us an email. The few people that you haven't put the money in your accounts yet, don't worry about it. It's coming this week. You're getting a better deal than the rest of us got. We got in a little bit earlier. This is something that I would definitely want to add to over time. I think it's so many things have changed there in that whole space, the semiconductor space. There's so many different areas that are growing. It's not just computers, laptops, iPads, tablet computers. It's not that. It's expanded. It's gone into a lot of different things. Solar panels. That's been a big boost for the demand for semiconductors. The LED lights, from what I understand, the processes are very similar, and a lot of them have semiconductors in them. I've got some light bulbs in my house that I control from my cell phone. They have semiconductors in them. How cool is that? You should see what you can do with that. That's pretty funny. But it used to be really expensive, and now it's not so much. And the prices continuously come down on that kind of stuff. So, and every time I say this, by the way, or I talk about something like this, inevitably, somebody calls me and says, okay, which one should I buy? And we'll talk about why that's not a good technique for maximizing your gains after these commercial messages. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned.
It's a new day, oh, it's a new time, and there's a new way, gonna live my life hard.
And we're back. Hey, if you'd like to call us, 216-901-0945. That's 216-901-0945. And feel free to give us a call. Feel free to check out our website, bullingtoncapital.com. I've got that upcoming seminar, and we're going to talk about learning basic portfolio management skills. It's interesting. I look back at the past few years, and it really reminds me of the 1970s. You had rising interest rates. You had 50 stocks that were a big part of the S&P 500 that had done very, very, very well. There really wasn't actually a fund to invest in those directly. That actually developed the S&P 500 was the timing wasn't all that excellent for that. I guess it was pretty good. They missed a part of the run up, and then they got started after some of those stocks had collapsed, because back in those days the S&P 500 had a 50% decline, the index itself, from 72 to 74. And it was because there were these stocks they called the Nifty 50 that had done so much better than everything else that led to overvaluation because of how that index is calculated, how they put it together. So the index itself did very poorly over the next couple of years. And a lot of your value-oriented funds that have been lagging the market by a pretty big margin actually had come back and done well and then ended up passing the S&P 500. And that's kind of the history with that. S&P 500 leads to overvaluation from time to time. And sometimes, it's years. It's long enough to convince you that it's not going to ever work. Whatever you're doing is not going to work. And I'm talking, it can be 4 or 5, sometimes 5 or 10 years where you're doing the right things, but people who are buying the stocks that just keep going up because they get bigger, and then the funds have to add to that because that's the way that their prospectus says they're going to invest, that'll end up doing better than them for an extremely long time period, sometimes by a lot. Inevitably, that's always corrected itself. And when I say corrected itself, I mean it goes into a period of underperformance from the more value-oriented stuff. But it's really tough, though. It's tough to live through. So anyway, if you'd like to call us, 216-901-0945. I'm going to go to the phones right now, and I have Rolf. Is that pronounced right?
Well, I don't know what you said, but it's okay. You got me now.
Okay.
I have a general question.
Sure.
If you go, most S&P 500 ETFs are cap weighted. Is that correct?
A large percentage of them are, yes.
Okay. Are the expenses different for the ones that are equally weighted?
It depends on who you're getting it from. There are expense ratios out there. The firms get to set whatever they are, so you have to basically look that up and find out whether they are or not.
Okay. And generally, if you are watching the financial TV shows or whatever, and they have the S&P 500, or even going on my computer over 5 years, they can give you, whatever.
Sure.
Would the equally weighted S&P 500 be better, lower, or about the same?
It depends on the time period. So if you go back really far, then the equal weighted is ahead by quite a bit. If you are looking at you could go over a 4 or 5 year time period in the S&P. That's kind of what I was talking about just a little earlier. The S&P will outperform an awful lot of stuff when the market's been going up and when the market's been dominated by institutional investing, because the institutions, which today make up, 97% of the volume. Institutions have I'm talking about pension funds, endowments, that sort of thing. They're so big that they have a tendency just to go into the market cap weighted indexes. And that's that can be a problem, because that's one of the things that leads to overvaluation in that index. So there are other ways of getting exposure. Your long-term returns are going to be fairly equivalent, but you can get a less of a drawdown. They're all stocks, so they're all volatile. And but if you're only down 40% instead of 57%, that's actually a win. In most people's minds, they don't think so. They're like, well, I'm still down a lot. Well, yeah, but you don't have to come back nearly as quickly or as much. If you're only down 40 versus 57, and that's the reality. And it's pretty tough, by the way, to only be down 40 when the S&P is down 57, and it has so much of an impact on everything around it and the mood. Investing is it's 95% psychology. It's how people perceive to be what's happening, not what's actually going on in many cases. And in a lot of cases, those two things are going to be incredibly different. And it's like this whole thing with tariffs. When you look at the amount of trade that we actually do and the overall size of our economies, $50 billion is not a drop in the bucket. It's a molecule in a bucket. It's incredibly small, but it affects the perception. It affects people's moods. It gets people worried, worked up, and scared. And quite frankly, that's one of the reasons, that's one of the intentions of announcing something like that and doing it, is to send a message So it's not necessarily the size or the actual values. It's really the message. They're sending a message. And that affects the perception of what's going on in the markets. And so if you look at the underlying, and that's actually why we're doing this next seminar, is to kind of take a look at what is normal. How would you know whether a mutual fund was lucky or if the stocks are overpriced if you don't know how to value a stock? And value stock is not as difficult as most financial advisors, or not financial advisors, but the industry itself. And even in business school, I can't tell you how many credit hours I took in finance when I was going to college, and it didn't help. I really had to learn the hard way in the field and applying a lot of stuff. And there are an awful lot of people who say things that are kind of meaningless, and then there are a few that really stood out that kind of tried to summarize it. When you've got a lot of advanced degrees, especially in finance, that's an entirely different language. It's hard for a lot of them to relate back to normal people. So that's what I'm going to try to do, is break that down. So I'll give an example. Say Procter & Gamble. I own the stock, and I haven't always owned it. In fact, I just bought a little bit of it just recently, and it's down a couple bucks since I bought it, which is no big deal to me. But if you look at Procter & Gamble and you look at the history of Procter & Gamble and what they make right now, over the past 12 months, they earned $3.75. So the price is the price is $78. And I don't have my calculator here with me. That's close to 5%. Okay, so it's like between 4.5% and 5%. And historically, that would be considered a fair price for a company, where the earnings yield is about the equivalent of the long-term average on a 10-year treasury. Okay, now some people like to use a 30-year treasury. I don't, because a 30-year treasury is incredibly volatile. I mean, the price movement on that. So I guess you could use that because stocks are incredibly volatile. But anyway, if I use 5% earnings yield as something, that's my bogey. I need to make at least 5% because I could have made 5% a year over the past 100 years by investing in 10-year treasuries. So why would you want to take less than what you could have gotten from a 10-year treasury? Does that make sense?
Yes. Now, my question, listening to your last talk, is where do dividends fit into all this? Because obviously...
Yeah. Dividends are a portion of the earnings per share that they actually pay out to the shareholders. Now, in the old days, in the early 1900s and the 1800s, companies would pay out 80 to 90% of whatever they made in profits because they couldn't get anybody to invest in the stock if they didn't. That makes sense? I used to have... I had some older clients when I was new in my career who had been around during the Depression and were investing, and we had conversations about that. And I was like, wow. And you couldn't get anybody to buy a stock that wasn't paying a dividend. And back then, the dividend yields were typically 5 or 6% because that's what you could get in treasuries or in a savings account, or not in a savings account, but in treasuries. So I was like, wow, this was, 22, 23 years ago that we're having these conversations. And I'm just going, wow, that's amazing. So nobody would buy a stock unless it paid a dividend. And it was like, yeah. And a dividend yield had to be good too. So they weren't really looking for the long-term growth on the company. They were looking for the current yield, the current income. And a lot of the investors back then, that's actually how they bought and sold their stocks. It was based on the dividend yield, which is a function of the profits, right? I mean, the dividend comes from the profit. So if you were paying out most of your earnings as a dividend back then, it was easier to value a stock because you could say, okay, I'm not going to invest in anything that doesn't have a 5 or 6% dividend yield. But at some point in time, they stopped distributing all the earnings, and they reinvested it instead in the businesses. So that now there are out of the S&P 500, I think there's around 100 to 150. I actually have to double check that when I get home, that don't pay any dividends whatsoever. I mean, none. So back in the 1940s and 50s, those stocks would have been incredibly difficult to sell to anybody. Nobody would want them. Almost every stock paid a fairly big dividend, and they started changing that when they started getting more sophisticated and saying, hey, look, if we pay out this dividend, we're actually going to have to go to the bank and borrow money to be able to grow our business. Why don't we just finance that ourselves? Because if we're earning 15%, 20% on the money that we reinvest, wouldn't that be better than paying it out as a dividend and then having to go to the bank and borrow money? And so that trend slowly started and caught on, so much so now to the point that a lot of your bigger companies don't pay any dividends at all, or the dividends very small as a percentage of their overall profit. So that's why you have to look at the earnings per share. And the earnings per share is, over the short run, a lot of stuff happens. So in the short run, they'll write things off. They'll have a one-time gain on something that, they bought and then sold that may not have anything to do with their everyday business. So you start with that, and that's your start. It's not where you finish, but that's where you start. You look at the earnings per share. You want to look over the past 12 months. You want to take a look at the longer-term history. And this is kind of all the stuff that we'll talk about at that upcoming workshop. And when you start looking at this, like Procter & Gamble it reported $3.75 earnings per share over the last 12 months. Okay, so, and I've been following this company for a long time. So I know I'm very familiar with a lot of their products. In fact, most houses in the United States have at least one of their products. Many houses have multiple products that Procter & Gamble makes. Company's been around for a long time. They're inexpensive products by and large. So it's not like buying a car. You buy a couple rolls of Charmin. I don't care how far the stock market goes down, you're going to buy Charmin or an equivalent. You'll buy that. You'll probably wash your clothes with some Tide or some other stuff. Something spills around the house, you might pick up a Bounty. So what I'm saying is that the products that they make are consumables, and people have a tendency to like to use a specific brand. And if they like that brand, then they use it a lot. If the economy slows down and people are having trouble getting loans, then housing starts to fall off. The sales slow down. People will start to hang on to their cars. So, the home builders and the auto manufacturers really suffer greatly when the economy starts going into decline. And this is kind of common sense stuff, I think. But oftentimes when I'm talking to people, that they're not, nobody teaches them to think in these terms. And I think that's really important, because when you're looking at a company and you're looking at the earnings per share, you want to go back and look at to how volatile those are. Now, how much do they fluctuate? All companies' earnings fluctuate from time to time, but some of them way more than others. And all other things being equal, okay, if you're going to hold on to a stock for a long time period, you want to see that the company's been able to, at least in the past, be a more steady or more stable. At least I do. But that's just me. Some people like investing in stocks that rely on the price of precious metals. I'm not a big fan, because I see how wildly those things fluctuate, how the price of the raw material fluctuates. It's not like Hershey's. People like me are gonna eat chocolate, probably more chocolate when the market's declining than when it goes up, because it's a comfort food. Does that make sense at all?
Yeah. Now, the only thing is, the earnings per share, it's whatever the company earned.
Hey, Rolf, can I get you to hang on for a second? Because I got to take a real quick commercial break. Okay, thank you. Yep. You're listening to Bill Bullington right here on 1420 The Answer. I'll be back after these messages. And I'm back. Rolf, you still there?
I am.
Hey, you'll have to remind me what we were talking about.
Well, you were talking generically about Procter and Gamble, but if I were running a large corporation, what would be the advantages of paying out all my earnings? The earnings go up, so the stock price would naturally at some point go up. But if I took all the earnings and bought back all my shares, that would limit the number of outstanding shares, and the price would also go up.
Well, it would go up as long as your buying was, and the other buyers were more aggressive than the sellers were. It could go down, because if the sellers were being more aggressive than the buyers, then even though you're buying back your shares, you may not be able to buy enough to offset the aggressiveness of the selling. Does that make sense?
Okay. Yeah, sort of. And then if I paid it all out in a dividend, the day of the dividend, the price of the shares go down as well. Is that correct?
Yeah.
Be less earnings?
Yeah, they give that. Yep, that happens.
So,
the idea behind the buybacks is that we're going to reduce the number of shares outstanding that we have to split up our future profits amongst.
So that'll make the earnings go higher the next time because you have
Yes.
fewer shares to divide up.
Yep, that's exactly.
Okay, so if the selling and buying is out of the question, it's then the price will go up.
Well, it will go up at least temporarily, but like I said, if some bad news came out about the company and other sellers stepped in.
That happens anyway.
Yeah, absolutely. So that's why I'm saying you can't, just because a company's buying back their shares is not a guarantee that it's going up. Because there are other extemporaneous events that could occur to cause it to go down anyway.
I've been listening to your show for a long time, and at one point I was thinking of transferring all of my assets to Folio, and it turned out that I have my assets in Scottrade, and they were taken over by TD Ameritrade, and predominantly my IRAs are in dividend-paying stocks, and it used to be Scottrade's. They would take all of your dividends, put them in a basket, and you could pick one stock that they would quarterly add to that position. Well, TD Ameritrade now has what Folio has, where as my dividends come in, they buy back shares of that specific stock, which is what I've always wanted.
Yeah.
So,
yep. That's a good thing to do. It's a really good thing to do.
Although I'm getting to the point where I start to have to take my required minimum distributions, and I'll probably start taking my dividends in cash and roll that over. At that point, I'm not of that age yet. But
yeah. That's
thank you for answering those questions.
Oh, no problem. Thanks for calling, and have a good day.
You too.
Yep.
Bye-bye.
Bye-bye. And I got to go to Gerry. Gerry, have a question for us?
Good morning, William.
Hey.
Yes, I do. I see, or it is my opinion that we're getting inside a trading range now, depending what's going to happen with the fall elections and the environment, from a international standpoint, so forth and so on. Do you feel, or do you agree with me? In a general broad sweep? No.
No,
Okay.
not at all.
Okay.
But, everybody's entitled to an opinion.
Okay, please pontificate on yours.
Well,
Where
I don't
do you see
think
the market going.
See, that's the problem. After all these years, you're still asking me that question.
Well,
question.
I just staked I staked out where I thought the market is inside of a trading range based on.
Well, let me tell you what the market's going to do. Okay, this is exactly what the market's going to do.
It's going to go up and it's going to go down.
That's right.
Okay. I figured as much that, but all right. It just seems there incredible volatility, Bill.
It's always been volatile.
Not to the extent that you go up 700 points one day.
Well, see, you're not looking at that in percentages, Gerry, and that's another thing that we've really, we've talked about this a long time. The percentage wise, it was 2%. 2 to 3%. And yes, the day-to-day volatility is higher. Actually, like I was talking about earlier on the show, from the year 2000 to today, there's been more days where the market's been up or down 2% than the entire. Actually, you go to World War II up to 2000, there have been more 2% days since 2000 than in that entire time period before that. And yeah, and that's a result of a lot of computer-driven models,
Sure.
exchange-traded funds, because people are not trading stocks anymore. They're trying to trade exchange-traded funds, and they end up losing, by the way. But it has changed. The underlying thing that hasn't really changed is that there are still real companies in there, and you can still invest. You have to be probably a little bit more patient, a little more tolerant of the day-to-day fluctuation. I wouldn't pay super close attention to it. It's not very beneficial for you to get an idea or a feeling about where the market's going to go. If you ever write that down and track that religiously for a while, you're going to stop doing that. And that's my point. I'm looking at over the next 5 years.
Okay.
And over the next 5 years, I think it's really good. Now, if there's only one area that's overpriced, and it's not even all that overpriced, and that area is large cap tech. There's some areas where you got a stock here, a stock there, like semiconductor industry as an example. That's part of tech, and there are quite a few names in the few hundred stocks that are in that space that are overpriced, but the vast majority of them are extremely well priced. So if you've got growth and extremely reasonable valuations, that's why I like that. Now, having said that, the market loves to make fundamental investors, and that's what you'd be doing in that case. You're looking at the valuations, you're looking at how the growth rates bend, what is going on to propel growth in the future. That's called fundamental analysis. You're a fundamental investor. Fundamental investors, by the way, are going to be out of favor sometimes for 5 or 10 years. And that is the really hard part about that. It is so tough. The markets don't behave like they're supposed to, and sometimes they can remain, I don't know what you would call it, out of sync with reality, I guess, for years. And that's what is so hard about investing. It's incredibly difficult.
Takes a hell of a lot of patience.
Oh man, you gotta have an outrageous amount of patience. And fortunately, I think today with the advent of big data, the computers are getting faster. You see those little chips that you put in your phone. It's got 128 gigabytes on it. That's amazing. So a lot of product in the past 5 to 6 years has come out that's been sorely needed. I mean, I left the brokerage community to become just an RIA, which meant that I have to be a fiduciary. And the way that my business was set up is that I only benefit if it benefits you.
Sure.
I get a pay cut when the markets go down and assets drop in value. I started doing that in 2004 because I thought that all these ETFs would be there in 2 or 3 years. It took them 7 or 8 years. And so 5 to 6 years ago, they started coming out. And then a lot of them would actually people didn't realize what was being offered to them, so they weren't investing in it. And the companies couldn't raise enough money to keep a lot of those funds alive. They had to shut them down. And so now, though, we're at a point where a lot of the funds, a lot of the things I really like that I thought was going to be here, almost a decade ago now, they've got enough money in them that I know they're not going away. And you can do this much more easily than you were able to at any time in the past. So is it, and are these things perfect? Well, they're stocks and you have people involved. So
Sure.
It's never going to be perfect. But over a short time period, man, trying to figure out what the market's going to do over the next 6 months or 12 months, anything less than 5 years, if you happen to get that right, there's going to be a large element of luck involved.
Okay.
So I try not to do that. I really try not to do it, particularly even when I used to do I did a lot more with trading breakouts. Well, I don't do that nearly as much because of the volatility.
Is the VIX? The VIX is a measure of volatility, isn't it?
Yeah, it is. And the VIX, actually, the price of the VIX that you can trade and the price of the actual VIX oftentimes are different.
Okay.
And that's another thing. You've got these funds out there that are trying to go short, go long. They use leverage, all this stuff. There are a ton of hidden costs that they don't have to disclose to you because it's impossible to figure out exactly what they are. There are these things called carrying costs. There are volatilities that get built in, implied volatilities, the actual volatilities. Wow, Gerry, we're going to have to continue this conversation next week.
Okay, I had another question, but I will talk with you next week, Bill.
Okay, well, thanks. You have a good one, too. Yep. Listening to Bill Bullington here every Saturday morning from 11 noon on 1420 The Answer. Have a good weekend, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420 The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.